Laurent, delighted to have you with us today.
Pleasure to be with you.
Let me begin. In addition to your role as a managing partner at Pictet, you also manage the asset management business and are client-facing, and you're responsible for the responsible investing activities of the business. My first opening question to you is, what do you see as the most important issues facing the world and your clients with regard to sustainable and responsible investing?
Well, I think there are many issues, and a lot of the focus has been on climate. And obviously that's an extremely important issue, but I think it's been a bit at the expense of other areas that are also very challenging. You can think about biodiversity loss, which can be extremely costly over the long term for the planet. You can think of water pollution and water consumption. You can think of inequalities. So there are a lot of very complex issues we need to face, and they represent different types of challenges. Typically, climate is an extremely important one, and one that we can measure relatively accurately, given the extensive research that has been done in this field. Whereas, when you talk about biodiversity loss, it's a bit more complicated. It's a bit more complicated to measure. It's a bit more complicated to find relevant data because disclosure is pretty poor. And it's also more complicated to actually articulate the real impact on the corporate world. So there are other dimensions that are extremely important. We need now to get together between science, professionals, the corporate world, regulators, to try to have the same type of momentum that we have today on climate. Now, the other set of challenges are obviously linked to transitioning. So once you have identified those challenges, you have measured them, you need to embark on the journey towards a better tomorrow, and that has risks. You can think about physical risks when you talk about climate. You can think about social impacts. You can think about consumption behaviors. But I think the important thing that we need to keep in mind is that the investments we make today are geared towards avoiding irreversible costs tomorrow. And that, I think, is the challenge when we talk to investors, to our clients, is to make them realize that that's the way forward.
Laurent, that's a big landscape you've laid out, a very big canvas of the issues. But before I dig into the next section, to dig a little bit deeper into this with you, what do you think are the consequences of us failing to do this well?
But I think if we don't have, a functioning planet, if we don't protect and nurture the capital that the planet is giving us, we're going to have dysfunctional economies, and that's going to translate into many different challenges. We're going to see rising inequality, migration, and also eventually, as far as we're concerned, it's going to translate into into the price of financial assets eventually, and therefore our ability to generate returns for our clients so that they can face the liabilities they're going to have when they retire.
That's very well put, I believe. In terms of your experience, let's go a little bit deeper into that. As an institution, and personally, if you don't mind too, what is the experience of being a responsible investor? Do you believe being a responsible investor is also being a smart investor?
Yeah, I think so. And I think this is what is now, I think, creating the momentum we've seen in the last, I would say, 2 to 3 years, where more and more investors is actually allocating their capital towards the more responsible part of the economy, trying to do smart investing by focusing on themes that address the challenges, them being environmental or social, that we are facing, and trying to harvest over the long term that sustainability premium that exists today. So in our conversations with clients, it's a question that comes repeatedly, regardless of geography, even though regulation is more or less mature depending on where you're looking. Regardless of client segments, it's a conversation we're having in almost all our discussions, with our clients. Now, the good thing about it as well is that it's not only about doing good, it's also about doing well. And I think people realize that taking into account non-financial factors in deploying the capital of our clients is only providing more insights to better mitigate the risk or generate performance for our clients. So it's actually becoming part of our fiduciary duty, not only to look at risk and return, but also to look at the impact of our investment decisions, because they will translate, we believe, in a better risk-adjusted return for our clients. So not only you put all the chances on your side, but on top of that, you do good. The role of active management is to try to analyze as many relevant data that have a material impact on the price of assets. And today it is very difficult to argue that some of those ESG dimensions do not have a material impact on the price of assets. They do, some more than others. And therefore, again, it is part as an active manager of our duty to look at those and incorporate them the same way we incorporate different types of dimensions, such as valuation of assets or the quality of the management.
And Laurent, would you say, as a hard-nosed manager of other people's money, you are seeing superior returns from doing good? I'm not confusing doing good with philanthropy. I mean, you're picking themes, you're creating funds, you're investing, you're measuring that, you're delivering a return. Is investing and doing good profitable for you and superiorly profitable for you?
Yeah, it is. And in many respects, I mean, as you know, we're one of the leaders in thematic investing globally. And we embarked on that journey in the mid-90s. And we started to deploy more environmentally focused thematic strategies, such as water in 2000. So we have a 21-year track record on this. Then timber, nutrition, clean energy, and others. And over the long term, they outperform the world equity markets by a substantial amount. So it has translated not only by allocating capital to companies that have an impact and because of the products and the solutions that they provide to the challenges of the environments, but it has also had a side benefit in that one of the big challenges we have in the industry, I think, is short-termism, is being measured quarter after quarter on our ability to generate performance over a certain benchmark. Now, when clients allocate their capital to a theme they fundamentally believe in, they can stem the volatility of the market over the short term. They go in for the long term, and therefore they allow themselves and they allow us as managers to harvest that premium. And a very concrete example of that is if we look at our thematic offering, and more particularly the environmental thematic offering, during the big crisis that we've seen, the big financial crisis, whether it was the dot-com bubble burst in 2000, 2001, whether it was the global financial crisis, we have not seen clients pulling out from those strategies, whereas they redeemed almost everything else to go into cash. So, they suffered drawdowns, but they rebounded with the market. And today they're very happy investors. So I think, the dynamic it creates in lengthening the time horizon of our clients, together with the secular risk premium you have, is making this a win-win solution from both, doing good and doing well for our clients.
That resonates very much. And my colleague, John Miller, when he began the panel session overall, spoke about the importance of the individual. Our analysis in our report, Capital as a Force for Good, shows that the individual begins with 2/3 of the world's money and 1/3 approximately is in the hand of governments. Of those 2/3 of the world's money and the world population of nearly 7.8 billion people, 20 million people have nearly $80 trillion of the world's global wealth. And many of those people, of course, care about this issue. And those are the sorts of people that are also your clients too. How do your clients think about sustainability and impact and the returns, that equation?
I think more and more we see clients, whether they are private clients or institutional clients, willing to have a purpose when they invest. Having a financial profit is not is not good enough anymore. And therefore, they do care about it. They have different dimensions sometimes that they care more about than others, but they definitely want to put purpose at the center of their investment focus. And we see that regardless of.
Sorry, Laurent. Go ahead.
And regardless of whether they are, high net worth individuals or whether they are, pension plans acting as fiduciaries, sovereign wealth funds, or government institutions.
Thank you, Laurent. Laurent, do you think you would lose clients if you did not have this responsible approach to investing that you describe?
Definitely. And even clients that we won before they were really looking at that and gave us a mandate which actually did not incorporate those dimensions are coming now today and asking us, so how do you adjust now your strategy to incorporate the analysis of non-financial factors? How does that affect my portfolio? How are you integrating those analysis in your decision-making process? So again, it's a conversation we have with literally any single clients today.
Are you prepared to exclude certain classes of investment, certain sectors, certain companies, because they cannot meet the requirements of being responsible to the environment or to social impact or to governance? Governance, of course, has long been a criteria, but the other two, are they important enough to exclude now?
Yeah, I think in certain cases they are. I think the general principle we have is that we need to be active owners of the companies we invest in. And being an active owner means obviously exercising your voting rights, but also engaging with those companies. And the biggest power of engagement is to accelerate the transition. Because first, you force them on a path towards being a better company, but at the same time, you harvest this sustainability premium that I was talking about before. There's a re-rating of those companies because they access larger pools of capital, they lower the liability risk. So there's also a financial element to it. So as a principle, we prefer engaging to excluding. As a client of ours told us once, he said, or she said actually, excluding is like throwing your garbage on your neighbor's lawn. So we exclude in certain cases. We exclude when a sector, by design, cannot transition. If you're a coal miner and you mine coal, it's very difficult for you to reinvent yourself. Yes. So typically we have a blanket exclusion from all our portfolios of this particular sector. Then we apply another set of more stringent exclusions on controversial sectors when we have solutions that by design are sustainable or thematic. So there's another set of exclusions for those strategies that label themselves and have intentionality to be a solution for those environmental and social challenges we have. Because again, we think that the exposure to those controversial sectors is irreconcilable with the intentionality of those strategies. And don't get me wrong, the assets we have in those strategies is important and it is growing year by year. Now, the third element of exclusion is linked to engagement, because obviously, unlike passive investors that can vote, they can engage, but they can't divest because they have to replicate a benchmark. As an active manager, if you feel that the path towards transition is not the one you expected, or is not happening, and that your engagement has failed because of the unwillingness of the issuer to change, then you need to divest and you need to exclude this company. So it's important that your engagement is framed in a way that you associate it with concrete targets and with a timeline. And failing to reach those targets or this timeline needs to have consequences.
Well, thank you. You've been very clear on how you think about the criteria for capital allocation and how you engage. We're in the last few minutes. Time's gone too quickly. We could have spent at least another hour or more actually on this. Let me ask you the final question, which is a very important one. We estimate it will take $100 trillion to the end of 2030 to achieve the Sustainable Development Goals. Previous estimates were placed at around $40 trillion. This reflects the impact of the pandemic, inflation, the numbers of people that have been thrown into poverty and since the pandemic, and actually in the years before, the need to raise the level of the world overall. How do you see us as a collective meeting these goals? What does it take? Do you have some thoughts and insights into, from your perspective, how we might do that?
I think it's going to be very difficult to achieve unless there is an alignment between the consumers that will have to change some of their consumption patterns, and they are very powerful. Grassroots movements are extremely powerful. Between corporates, through disclosure and through changing their practices, realizing again that an investment today will translate in avoiding costs tomorrow or into an opportunity tomorrow. Investors like us that actually allocate the capital on behalf of our clients and therefore have the power to feed or to starve issuers based on their ESG behaviors. Regulators that can accelerate the transition, and governments. And I think the good news is that there seems to be an alignment taking place among those. You can question whether it is rapid enough, forceful enough, but it is happening. And I have to say that in an industry that likes in general relatively light regulation, I think that the EU action plan, which is being put in place, is a very good plan to accelerate that transition. And I hope that others are gonna follow suits without reinventing completely the wheel, but to try to force changes. I think the corporate world, the consumers can do it, are willing to do it, but we need the accelerator, which comes from governments and regulation.
Laurent, that's very interesting. Thank you. You sound like a man who's ready for a new financial revolution to happen.
Yeah, I hope that actually in 10, 20 years, we won't talk about sustainable investment because it's going to be part of what we do.
Thank you. Thank you very much for that.
It's a pleasure. Thank you.